All right, let's talk about one of the most important investing books ever written. We're going to dive deep into the timeless wisdom of the intelligent investor and see how we can master the market with the man himself, the legendary Benjamin Graham.
So let's start with a really big question, one that Graham put front and center. When you put your hard-earned money into the market, are you actually investing or are you just rolling the dice? For a lot of people, that line is super blurry. Graham saw that most people were basically treating the stock market like a giant casino. And this is where Graham just cuts through all the noise. He gave us this crystal clear three-part definition. A real investment has to do three things. First, it's based on thorough analysis. Second, it has to promise safety of your principal, meaning you're not likely to lose your shirt. And third, it offers an adequate or satisfactory return. If it doesn't check all three of those boxes, well, that's just speculation. And the difference in mindset here is it's everything. You see, an investor looks at a business and figures out what it's worth, then looks at the stock price. A speculator does the complete opposite. They look at the price and try to guess where it's going. An investor wants to own a piece of a real business. A speculator is just kind of renting a stock, hoping to flip it. It's a world of difference. So who was this guy who brought all this logic and reason to the Wild West of Wall Street? Let's properly meet our mentor for this journey, Benjamin Graham. Graham's philosophy wasn't just some academic theory. It was forged in fire. He was born in 1894, and as a kid, his family lost everything in a market crash. Can you imagine? That experience, combined with a brilliant mind that graduated from Columbia at just 20, drove him to create a system to protect people from that very same fate. And in 1949, when he published The Intelligent Investor, he literally changed the game forever. And hey, you don't have to take my word for it. Graham's most famous student, you might have heard of him, a guy named Warren Buffett, calls it, and I quote, by far the best book on investing ever written. I mean, that's pretty much the ultimate endorsement in the world of finance, right? Okay, so now that we know the man, let's get to his secret weapon. The one single concept, the absolute bedrock of his entire philosophy. It's called the margin of safety. Graham himself called this the central concept of investment. So what is it? Put simply, it's a buffer, a cushion. Its whole purpose is to make it so you don't have to be perfect at predicting the future. It gives you room to be wrong. To really let this idea sink in, let's use a super simple analogy. Just imagine you are an engineer and you're building a bridge. Now, your calculations and your materials say this bridge can handle a maximum weight of 30,000 pounds. That is its absolute engineered limit. But to be safe, you put up a sign that says maximum load 10,000 pounds. That massive 20,000-pound gap between what the bridge can hold and what you've let it hold, that is your margin of safety. It protects you from surprises, bad weather, anything you didn't see coming. Now, let's apply that exact same thinking to stocks. Say you do your homework and figure out that a business is really worth about $100 a share. An intelligent investor doesn't pay $99 for it. No way. You wait patiently until you can buy it for, say, $60. That $40 difference, that's your bridge, that's your margin of safety. It's your financial cushion against all the unknowns. So you've got this powerful weapon now, but you still have to face the main villain of every investor story. And here's the twist. It's not a recession or a market crash. The real villain is your own emotions. And Graham gave it a name, the unforgettable Mr. Market. Graham tells us to imagine that we're in business with this guy. And this partner of ours, Mr. Market, he's a little bit manic depressive. He shows up at your office every single day without fail. On some days, he is just bursting with joy, totally euphoric. He's convinced your business is going to the moon, and he offers to buy your shares from you at a price that is just ridiculously high. But then, on other days, he shuffles in just terrified. He's sure the world is ending, the sky is falling, and he's so desperate to get out that he offers to sell you his shares at a ridiculously low price. So, here's the million-dollar question. What do you do with this guy? Do you let his wild emotional swings dictate your financial future? Do you buy when he's happy and sell when he's scared? Graham's answer is a resounding no. You don't get caught up in his drama. You ignore him most days, and on the rare days he's being completely irrational, you take advantage of his foolishness. And that brings us to your investor playbook, choosing your own path. See, Graham knew that one size doesn't fit all. He laid out two basic paths. First, there's the defensive investor. Their main goal is safety and avoiding big mistakes. They want dependable, pretty average results without a ton of effort. Then you have the enterprising investor. This person is willing, even eager, to put in the time and research to try and beat the averages. The key is to be honest with yourself about which one you are.
Okay, let's bring our journey full circle. When you truly absorb these big ideas, the margin of safety, the true nature of Mr. Market, you go through a transformation. You stop being a speculator, tossed around by the market's every whim. You become an intelligent investor. And Graham's final piece of advice is probably the most powerful. He says, have the courage of your knowledge and experience. In other words, you're right because your facts are right and your reasoning is sound. Not because the market agrees with you or because your neighbor does. Trust your own work. And that's really the heart of it all. Graham doesn't give you a formula to follow blindly. He gives you a framework so you can think for yourself. So the real question I'll leave you with is this. How will you take these timeless principles and apply them to your own investing journey?